Takes us to our talk of the tape. Whether stocks can continue to rise if bond yields do as well. Now, let's ask Anastasia Amoroso, iCapital's chief investment strategist, with me here at Post 9. It's good to see you.
Good to see you, Scott.
That is the key question, right? If rates continue to back up, are stocks going to go down?
Well, so far, so good for stocks, even though bond yields are rising. And of course, the reason for that is that bond yields are rising because growth is improving as well. And yes, there's also an improvement or deterioration, I should say, in inflation expectations. But for now, because you have better earnings expectations, we can shake that off. So I think if the moves are somewhat contained here, I think we're fine despite the backup. But obviously, if you have anything closer to a breakout to 480, I think we would have to worry about.
Okay, so you agree with what Tony Pasquarello of Goldman Sachs was talking about in his new note, where he says, he asks this question, which I think is the most relevant question of any right now. When do higher rates begin to bite?
Yeah.
And he suggests a move towards 480 is where things could get tricky.
Yeah, I think the move right now has been more about the pickup in economic growth. It has been about stronger payrolls. It has been about stronger manufacturing, and therefore the Fed pushing back the rate cut expectations. But to the extent that the move starts being driven by inflation expectations, so of course we've got CPI on Wednesday, and if that's a surprise and that continues to reprice the inflation expectations higher, I think that's where it becomes dangerous for stocks.
Are you still optimistic about the overall direction for the market and the economy? Right, Jamie Dimon's out talking in his letter about sort of we have this foregone conclusion almost the markets do that it's going to be a soft landing, where he says markets are pricing in 70 to 80% chance of that. I believe he says, quote, the odds are a lot lower than that.
I'm still in the soft landing camp, but I actually think that the last several weeks or months of data has really reinvigorated the no landing camp. And so we wrote this piece last week about an uptick in manufacturing. I actually think that's a really big story for the rest of the year, is we're starting to see an uptick in the U.S., China, global manufacturing, new orders component is improving. But I think we're early innings of what is typically a 9-month uptick in manufacturing. So if that's the case, then you could have a lot of cyclical momentum that develops in the economy. And Scott, this used to be a one-engine economy with the U.S. consumer really supporting the globe and supporting all the industries. But now if that broadens out and you can have industrials and materials and energy participate, I think that's what gives me confidence on the economic front.
Do we need rate cuts or not? And if we need them, how soon do we need them?
Maybe not. Maybe not for the broader market. And that's really the question that we had to ask ourselves last week is, can the market still be okay without the rate cuts? I think the answer is yes, because, of course, Scott, I looked to the earnings picture, and earnings for the S&P expected to be up about 11%. We're looking at the earnings revisions, and the net earnings revisions have flipped into positive territory. And I suspect as the year progresses, and if we're right on manufacturing, we'll see the cyclical earnings uptick as well. So if that's the case, then maybe you don't actually need rate cuts, especially if the consumer is able to function with that. The caveat that I would have to that is not everybody needs a rate cut, except if you're an interest rate sensitive sector. So if you're in real estate, if you're in housing, if you're in unprofitable tech, I think it does get painful.